If you're watching this right now, you're early. And that matters. I'm seeing a lot of people scrolling past headlines about silver, treating it like just another red day. But what just happened in silver isn't normal, it isn't random, and it definitely isn't over. In less than 24 hours, silver dropped 21.5%. Let that sink in. From about $120 an ounce to roughly $97. That single move wiped out an estimated $1.4 trillion in paper market value. Think about that number for a second. $1.4 trillion. That's more than the entire GDP of Spain. Gone. And here's the part that should immediately grab you. Physical silver prices in China barely flinched. Both COMEX pricing and the Shanghai Gold Exchange data confirmed the same thing at the same time. This wasn't demand collapsing. This was leverage breaking. Stay with me, because I'm going to show you how to recognize this pattern before it shows up on your screen next time. Now, before I explain what caused this, let me teach you something most people never really internalize about markets. Price isn't always about value. Sometimes price is about pressure. And you need to understand the difference if you're going to survive moments like this. Think of the futures market like a crowded elevator held up by cables made of borrowed money. As long as those cables hold, the ride feels smooth. Everyone's comfortable. But when leverage builds too fast, when too many people pile in using money they don't actually have, one snapped cable forces everyone to jump out all at once. And here's what makes silver uniquely dangerous in these situations. It's smaller, it's thinner, and it's more heavily leveraged than gold. When silver runs, it runs on borrowed fuel. When that fuel gets cut, gravity does the rest. That's what you're watching right now. Not a fundamental breakdown, a mechanical one. So what does that tell us? It tells us that you can't just look at price and assume you understand what's happening. You've got to look under the hood. You've got to see who's buying, who's selling, and most importantly, who's being forced to sell. That's the key, because forced selling is a completely different animal than voluntary selling. It doesn't care about your thesis. It doesn't care about fundamentals. It just needs to happen, and it happens fast. Now here's what's actually happening under the hood. Let me break down the sequence, because this matters for how you react to what comes next. Silver had gone parabolic. I mean vertical. Futures positioning exploded as traders piled in, convinced the rally would continue forever. Meanwhile, margins rose quietly in the background. Most people don't even notice when exchanges raise margin requirements. It's boring, it's technical, but it's the fuse being lit. At the same time, liquidity thinned. As prices went higher and higher, fewer real buyers showed up to chase them. You had speculators trading with speculators, passing the same contracts back and forth. Then price dipped. Just a little, maybe a couple percent. Nothing dramatic on its own. But that dip triggered margin calls. And that's the first domino. See, when you're trading on leverage and price moves against you, your broker calls you and says you need to post more collateral, more cash, more assets. If you can't, they liquidate your position automatically. No discretion, no opinions, no waiting to see if you're right. Just sell, right now, at whatever price the market will give them. That selling pushes price lower, which triggers more margin calls, which forces more selling, which pushes price even lower. And here's what's wild about this, what most people miss completely. None of that requires a single investor to suddenly hate silver. It's mechanical, it's forced. It feeds on itself in a loop that accelerates until all the leverage is flushed out of the system. You could have 10,000 people who still love silver, who still believe in the long-term story, but if they're all overextended on margin, it doesn't matter. They're getting sold out whether they like it or not. But here's the part that should make you pay attention. While paper silver was being dumped at any bid available, while traders were liquidating positions in a panic, physical markets told a completely different story. Shanghai premiums stayed elevated. We're talking well over historical norms. That's signaling real-world tightness. People in China were still willing to pay significant premiums to get actual physical silver in their hands. That divergence is your tell. When paper collapses but physical refuses to follow, you're not watching fundamentals break. You're watching leverage get flushed. And leverage flushes don't end trends. They reset them. Let me show you something that'll make this even clearer. This is the exact same playbook silver has run before. We've seen this movie. In 2008, during the liquidity crisis when Lehman Brothers collapsed and the entire financial system was freezing up, silver got destroyed. It collapsed over 50% as everyone scrambled for cash. Funds were selling anything liquid just to meet redemptions. Silver got crushed. What happened next? It rallied more than 400% into 2011. Same metal, same fundamentals underneath. But once the forced selling exhausted itself, price snapped back hard. In 2011 itself, we saw a margin-induced crash wipe out over 30% in just days. COMEX raised margins multiple times in a week, and leverage longs got obliterated. Price went from around $50 down to the low 30s in a matter of days. People thought the bull market was over. It wasn't. Price stabilized, reaccumulated, and continued higher. March 2020 did the same thing. Remember that? COVID panic hit, and silver plunged as funds sold anything liquid to raise cash. It dropped from over $18 to under $12 in weeks. Then what? It doubled within months, hitting $30 by August. Every time, same pattern. Violent downside, forced selling, physical strength underneath, then repricing. The larger story here is that silver doesn't drift lower when this happens. It snaps, and when you zoom out and look at the big picture, these violent shakeouts tend to mark inflection points, not endings. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be the start of something worse? Sure, absolutely. If physical premiums collapse, if we see inventories flood into exchanges, if industrial demand evaporates because the economy's rolling over, that changes the story completely. I'm not going to sit here and tell you that's impossible. And I'll be honest with you, manipulation narratives don't help you here. I see people in the comments all the time talking about how the big banks are suppressing price, how this is all orchestrated. Maybe, maybe not. But here's the thing. Markets don't need villains to break. They just need leverage. They just need too many people making the same bet with borrowed money. So focus on what you can control. Watch spreads between paper and physical. Watch margin requirements. Watch physical signals like premiums and delivery demand. Price alone will lie to you in moments like this. It'll tell you the sky is falling when really it's just the leverage being wrung out. There are probably 3 types of people watching this right now. If you're overexposed and stressed, if you're sitting there feeling like the floor just disappeared under you, take a breath. I know it doesn't feel like it, but forced selling phases end faster than you think. They're violent, they're scary, but they're temporary. Your job right now is survival, not heroics. Don't try to catch the falling knife. Don't add to losing positions out of stubbornness. Just survive. Let the market stabilize. If you need to reduce exposure to sleep at night, that's okay. Living to fight another day is more important than being right on the exact bottom. If you're on the sidelines, if you've been skeptical and waiting for clarity, that's valid. Your edge is patience. Don't feel like you need to jump in right now just because price is lower. Let the market show you stabilization. I'd want to see silver hold that $95 to $100 zone for at least a few days, maybe a week, before I'd consider it safe. Let open interest decline. Let the forced selling exhaust itself. You'll know when the coast is clear because volatility will compress and price will stop making those violent intraday swings. And if you're long-term bullish, if you've been expecting volatility like this and you're prepared for it, this is where discipline matters most. Scale. Don't chase. Don't blow your whole load trying to catch the bottom. Build positions slowly. Respect the process. Use this opportunity to average in at better prices, but do it methodically. Set levels. Stick to them. And if price keeps falling, don't panic. If your thesis hasn't changed, use it. For all of you, regardless of where you stand, the universal principle is the same. Understand the mechanism before you react to the headline. When you see a 20% drop in a day, your first question shouldn't be, should I sell? It should be, what's causing this? Because if it's leverage breaking, that's temporary. If it's fundamentals breaking, that's different. So here's what I want you to answer in the comments. Where are you in all this? Are you holding physical and feeling okay? Are you trading paper and getting squeezed? Are you waiting on the sidelines trying to time an entry? I'm curious where everyone's at, because I think we can learn from each other's perspectives. Here's where I stand. I'm not euphoric, and I'm not panicking. I'm focused. Let me tell you what I'm personally watching. First, I'm watching that $95 to $100 zone for stabilization. If silver can hold above $95 for several days without making new lows, that would indicate the worst of the forced selling is behind us. If it breaks below $95 cleanly, I'd want to see where it finds support next. Second, I'm watching Shanghai premiums. Right now, they're staying above 20%. That tells me real supply stress remains in the physical market. If those premiums collapse back to normal levels, that would suggest the physical tightness story is weakening. But as long as they stay elevated, it confirms what I'm seeing. Divergence, paper selling, physical holding. Third, I'm monitoring futures open interest to see when forced selling exhausts itself. When open interest stops declining, when it starts to stabilize or even build again, that's your signal that the liquidation phase is over. Based on my analysis, this event was mechanical, not emotional. It was structural, not random. The fundamental picture hasn't changed. We still have supply deficits. We still have industrial demand from solar, from EVs, from electronics. We still have investment demand from people worried about currency debasement. None of that disappeared overnight. What disappeared was over-leveraged positions that couldn't survive a margin call. That's it. If history rhymes, and I think it does, this kind of reset tends to mark inflection points, not endings. These violent shakeouts scare out the weak hands, flush the leverage, and set the stage for the next leg higher once confidence returns. Now, I'm not a financial advisor. This is not financial advice. I'm just a guy who watches markets, studies patterns, and shares what I'm seeing. You need to do your own research. You need to make your own decisions based on your own situation, your own risk tolerance, your own timeline. But if you made it this far, you're thinking critically. You're not just reacting to headlines. You're trying to understand what's actually happening beneath the surface. That mentality will serve you well, not just in silver, in every market you ever trade. The ability to stay calm, to think mechanically instead of emotionally, to see forced selling for what it is instead of panicking with the crowd. That's the edge. If this breakdown helped you see things more clearly, share it with someone who needs to hear it. Subscribe if you want more analysis like this, and stay ahead of the noise. Think critically, verify the data, watch the signals, and make your own decisions. Stay sharp out there.